wage growth and company costs are going up. So really by pressing the brake, by raising interest rates, they're trying to gently slow demand in the economy, bring it back into balance, and ideally bring inflation back to that 2% target in 2 to 3 years.
What will the Bank of England do on interest rates today? The expectation is that we will get a big increase. Our business correspondent Dominic O'Connell is here. He'll stake his reputation on a clear prediction. I know he will. Dom, it's probably going up though, isn't it?
I will not stake my reputation. Yes, the forecast is for an increase of 0.75%. That'll be the biggest one-off increase since 1989. Take bank rate to 3%, the highest it's been in 14 years. Liz Martens is chief UK economist at HSBC, and she joins us now. Liz, good morning. We're talking about that it's going to be an increase of 0.75%, but it's worth remembering that is not guaranteed, is it?
No, of course not. Nothing's guaranteed. In fact, I was just looking at the forecasts for today among economists. Almost all of us are going for 0.75%, including myself, but a couple going for just half a point and a couple even going for a whole percentage point. For me, the risks are really towards a smaller rate rise rather than a bigger one, given the sort of nasty news that we've had over the last few weeks on the economy, the surveys suggesting that we are slowing down into a recession, and also the fact that a lot of people forecast that big rise, that 0.75 point rise, on the back of a lot of fiscal loosening, all those tax cuts that Liz Truss gave us, most of which have now gone. So I do think the risks probably weighted towards a smaller increase rather than a bigger one.
Just before we talk about the possibility of a smaller increase a bit more, just remind us, what is the Bank of England or what is the Monetary Policy Committee trying to do here by increasing interest rates?
Yeah, they're trying to reduce the chances of inflation getting out of control. So there's nothing they can do about the fact that inflation's kind of 10% now, and it's going to be 10% for a few more months. That's driven by energy prices. It's kind of beyond their control. They're looking 2 to 3 years out to make sure we don't get into a spiral whereby we expect inflation to be high, we demand higher pay rises, it gets kind of self-fulfilling. And that's the bit they're really worried about. And the other part, of course, is the tightness of the labour market, which means wage growth and company costs are going up. So really by pressing the brake, by raising interest rates, they're trying to gently slow demand in the economy, bring it back into balance, and ideally bring inflation back to that 2% target in 2 to 3 years.
So what happens if they don't do this 0.75%, if they do less, say 0.5%? I was very struck, Karen Ward, one of your rivals, who's now one of the wise people advising the government on the economy, said that if they did do less than 0.75%, there's a chance of a repeat of the bond market kerfuffle we had 3 weeks ago.
Well, I mean, I think what she would mean by that is the market would believe the Bank of England hasn't got this under control now, is not doing enough now, and therefore would have to do much more later on. Personally, I probably wouldn't ascribe as much probability to that happening. The market is expecting almost 100% chance of a 0.75 point today. So they're pricing in about 72 out of the 75 basis points. So it would be a surprise if it was 50 instead. However, when we've been talking to clients in the markets in the last few weeks, a lot of people know that it is a possibility that it will be less. So likelihood, I think it would be a surprise to the market. Maybe the currency would react negatively in the immediate term. And maybe it would open up those questions that the BOE will have to do more later if it doesn't do as much now. But a repeat of that would be extreme, I think.
Well, what's your forecast for how high interest rates could go, say, in the middle of next year? When do we peak out in this round of increases?
So our forecast is that we have 4 more, including today. So November, December, February, and March, and we get to 425 at that point. I have to say, we've made those forecasts, again, with all of Liz Truss's fiscal easing in mind. And given that that's now off the table, and actually Jeremy Hunt's going to give us fiscal tightening and spending cuts and tax rises on the 17th of November by all reports, the reality is that actually against that backdrop and given a slowing economy, we might even get less rate rises than what we're forecasting. So 425 is the forecast, but risks, as I say, I think more to the downside at the moment.
Thank you very much, Liz Martens, Chief UK Economist at HSBC. And just before I go, we just had results from Sainsbury's. Profits are down a bit, 8% to 340 million. Quite interestingly, their sales of fuel, the amount they make from selling fuel, was up nearly 40%.
And why is that, Dom? Is that because that petrol price is being up during that period?
I think it's petrol prices being up, and also people trying to take advantage more and more of the idea you buy a certain amount in the supermarket and you get slightly cheaper fuel, but mainly higher fuel prices. And I think supermarkets are going to come under more pressure now to be a bit more upfront about the margins they make on their fuel sales.
Yeah, interesting stuff. Dominic O'Connell, as ever, great to speak to you.